Good evening. It's Saturday, the 17th of January 2015. I'm going to do a review of US markets and where I think they're headed going into Monday, the 19th of January 2015. Obviously, for the commencement on Monday's trading. Give you my view. As always, my name's Adil, and as you know, I operate within the framework of intermarket analysis, and I'll give you my hindsight and foresight as to where this market is going to go. Okay, so earlier in the week I said to you the HNS on the S&P 500 would crack and would break below the 2000. That's exactly what happened. Okay, and then I explained to you that thereafter, obviously after the events had occurred post the SMB and the CHF or Swiss National Bank intervention, that would short squeeze and move higher, and this pivot bottom would hold, and that's exactly what happened. We had a bullish engulfing candle, and that, if you see my tweets in the timelines, it's also all documented in time-stamped, call it whatever you want, it's all documented there. Okay, so finished the week off with around 140 points, so okay, although I did get stopped out of my FTSE short towards the end of the week, which was quite surprising given the fact that oil prices still are not exactly making a major comeback. But having said that, has to be respected for it is. Price action is price action, and obviously that's why our stop losses are there to protect us from being wrong. So overall 140 points for the week, so no complaints there. It's a positive week. As you know, I always attempt to average 200 points a week. I've been doing that for almost 10 years now on the live analysis service. So those of you that want access to my real-time trades and analysis, then you can join that service if you want. Okay, right, where are we? Okay, so fundamentals. Let's discuss fundamentals. So what were the main fundamentals on Friday? We had a strong consumer confidence data. We had lower inflation data. So they were the two reasons why I went long the Nasdaq. And as you can see, my inverted head and shoulders formation call. If I just show you the inverted head and shoulders first of all, which I tweeted out to everybody on Twitter, I explained that this pattern would play out, and that's exactly what happened. And then I also tweeted out that this pattern on the Nasdaq would play out, and that's exactly what happened. So if you go to your 10-minute chart, as you can see, inverted head and shoulders, that's basically where it's going, right? Okay, so where do we go now? Fundamentals. Okay, so first of all, let's start off with Friday. So fundamentals from Friday, we had lower inflation. Okay, so obviously that helps or supports the idea that obviously interest rates are going to be pushed back and won't be coming anytime soon. Okay, so that's one way of looking at it. Let me just get this organized 1 second. Caramba. Okay, here we go. So yeah, so US CPI month on month obviously dropped to minus 0.4%. So again, that's not exactly indicating that interest rates are going to be rising sooner. Okay, although we did have industrial production come out relatively weak, but to counteract that, we had the Michigan or Reuters Consumer Sentiment Index that came out much stronger than expected. Okay, although we did have Mr. Bullard coming out with some hawkish comments towards the end of the day, but having said that, the markets were obviously focused on the QE. Okay, so first of all, US data obviously relatively supportive of US markets, number one. Number two, the talk was all about QE. Okay, so it's about QE and about Brexit. Now I have tweeted something on on my Twitter feed stating that there is a potential for a 6-month loan extension. So Eurozone ponders up to 6-month Greek program extension, third bailout. Okay, so that's on my Twitter feed. So those of you that are not familiar with my Twitter feed and you want to follow me, okay, this is my Twitter feed. It's trader_Adil. So find me on there, trader_Adil, and you should be able to locate me on there. Okay, so follow me on Twitter. Okay, so there's an article on there, so you can always refer back to my so chronological, so you can go back and scroll back. So Eurozone ponders up to 6-month Greek program extension, third bailout, etc., etc. So this is obviously one of the reasons why the markets may well have rallied substantially. Okay, and the other one is obviously the Spiegel report that came out later in the day that obviously promoted QE. So there was a report that's been given to Merkel with regards to Merkel advisor says ECB should be patient on QE. Interesting. Okay, so that's on the weekend though. Let's have a look at the reports yesterday. Let's have a look. Let's go back slightly. Going into Friday. Okay, so yeah, Spiegel reports. There we go, the Bloomberg article. Okay, so European Central Bank President Mario Draghi briefed German Chancellor Merkel, Mr. Wolfgang Schäuble, as we all know, Mr. Weidman, I'm not sure where he is, on QE plan that national central banks would buy buying bonds issued by their own country, etc., etc. So basically, the whole concept is that stock markets are rallying higher on expectations and anticipation of QE. Number one, okay. So given the fact that they're running higher in anticipation of QE, that obviously was helping propel the markets and move the markets higher. And as you can see with regards to the German DAX, the German DAX actually went and made a new high. So if I go to the German DAX, and you can see there we go. Okay, so German DAX obviously made a new high. So that has to be respected. Regardless, okay, so it has to be respected regardless. So German DAX made a new high, given the fact that obviously all talk about QE. So when you have QE and Grexit fears being alleviated to a certain extent because there's rumours of a potential third bailout or extension, etc., that these are all potentially obviously can be potentially bullish signals. Although having said that, the counter argument was the uncertainty with regards to the aftermath of the SNB decision. So the Swiss National Bank. So as we all know, I mean, this just on the weekend now. I mean, if you look at follow my tweets, there's a hedge fund that got wiped out. I think he had 830 million in assets, and the whole hedge fund has been wiped out. Now, they're only stories that are coming out now. I mean, God knows what else is going to come out on the weekend, okay? And the losses facing that, and so on and so forth. With the CHF obviously moving higher, obviously the peg with regards to the euro, obviously at 1.2 being negated, euro CHF. So did they front run the QE, knowing that QE would obviously debase the currency, and they didn't want to waste money defending the euro CHF. So again, could be a multiple number of reasons. Maybe they knew about the Greek exit. Okay, maybe that could be the reason why. One of the reasons why they knew of Brexit occurring. Therefore, they didn't want to be part of the volatility and the insanity and what would obviously result. As we already know, as you can see, I mean, so many companies like such as El Pari and FXCM are basically have almost shut their books. Okay, and they are on the verge of bankruptcy. So that's basically what can cause losses as well. So there's a lot of uncertainty, etc., with regards to that, and also the question of the CHF now being a safe haven. Now there's talk over the media over the weekend now whether or not whether Switzerland is a safe haven, and as we all know, the three safe haven currencies are JPY, US dollar, and CHF. If one of those obviously cogs in that variable is adjusted, then that's not exactly a bullish sign, is it? Again, it's a cause of concern. So there's a lot of uncertainty, and the stock markets hate uncertainty. So there was an argument on both sides. There was an argument of QE, Brexit fears being alleviated, stronger economic data overall, promoting obviously lower interest rates in the US in the future. Then the counter argument, obviously, with the CHF incident and the results with regards to the peg itself being removed. So again, it's pros and cons on both sides, really. To be honest with you, I mean, my FTSE position swing short was based on that premise, given the fact that obviously you had all these companies and rumours of hedge funds going under, etc., and that leads to liquidation, and obviously generally leads to risk off in the marketplace in and of itself. Now obviously we know oil obviously has been under immense and intense pressure, and as you can see, the Euro CHF, I mean, if we bring up a chart of the Euro CHF, where are we? Yeah, I got a chart here. Let's see. I mean, there's your Euro CHF. I mean, you had one hell of a initial sell-off in the Euro CHF, and it has been trying to make a comeback, or has been potentially stabilizing there now for now. So that's going to be very, very interesting. So that is quite a substantial sell-off in the Euro CHF, and also the Aussie CHF as well. I mean, if you bring up the Aussie CHF and the NZD CHF, you can see there one hell of a sell-off. So the CHF itself, obviously, with it being with the NZD CHF going down, or the Euro CHF going down, or the Aussie CHF going down, I mean that's CHF is strengthening. So when CHF strengthens, that generally classified as risk off because due to the nature of the stock market globally. And like I said, according to Intermarket Analysis, and according to Mr. Murphy, whenever money goes into CHF, then it's generally classed as a safe haven. But this again is open to interpretation. Okay, so that's basically what we see there, and that's not exactly a positive sign. So it's whether or not the market can overcome these fears. I mean, it's overcome Ebola, it's overcome the Russia-Ukraine situation. I mean, it's overcome almost every single crisis there is. So given the fact that QE obviously is there, and as long as QE is there, it generally tends to trump it and move higher regardless. Okay, so where do we go now? Because there is a divergence between European markets and US markets. So let's try and work this out. Now that we know all the facts and figures. Now over the weekend, we've had comments out of Germany again that are indicating that they're happy with the situation or status quo, i.e. they don't need more QE. Now, as you can see here, Merkel advisor says ECB should be patient on QE. Now, given the fact that Euro has fallen quite substantially, now if I just bring up a chart of the Euro USD, and you can see how the Euro has fallen quite substantially. I mean, Euro is went as low as a 1.4460 level. Okay, so given the fact that the Euro is down quite substantially and is at that level, and obviously is making a new low, then certainly one would argue that the Euro itself is in a firm downtrend, and there's no real reason for us to for the market in and of itself to actually put in a reversal. Okay, now from my perspective, QE has already been priced in, because that's what the aim of QE was. The aim of QE was in and of itself is to obviously reduce the level of currency, and that helps the export sector, and the stock market starts to revive by itself. Okay, that's what they wanted to do in 30, and they've achieved that to a large extent. They have. It certainly has been achieved, and whether or not they hit the 1.1 level, that's basically the whole debate now. Whether the CHF and whether the European Central Bank maintain dovishness, and with regards to monetary policy, and cause the euro to fall even further, and whether or not Draghi does what he has to do. Now, given Mr. Draghi's comments, and given the fact that the news media over the weekend is reporting that the risk will be lying on the central bank itself, that's not exactly a good sign. Ideally, when I say central bank, I mean the national banks. It's the national banks that will have it's the national banks that will have all the risk, or will be embracing risk, not the European central bank. So that's overall net negative. But given the fact that they're pleasing the Germans and the Germans are happy, then rather than getting no QE at all, at least they have some form of watered down QE regardless. Now again, that's helping the markets. But I do think the real reason is because of the Greek. There's some sort of Greek deal in the background, because QE alone couldn't force a DAX to go higher. There must be something with regards to that, and also with regards to the GDP data as well that came out. Germany was quite strong, and they have got a balance of budget deficit. Well, not deficit, balance of budget. Their balance of budgets that are break even. So their trade of exports versus imports, okay, of goods and services, etc., is break even. So they're in a sound position, a very healthy position, Germany. So again, that's one of the reasons why you can certainly expect the German stock market to make a new high, whilst others are lagging. Okay, so now we know all that part of the equation. Okay, what will be the dominant themes going into Monday? Dominant themes will be regarding the Swiss National Bank. Given the fact that there's several hedge funds that are now reporting liquidation, and certain brokerages that are liquidating, and given the fact that QE is more or less all priced in, okay, and given the fact that obviously we did have the Nikkei negative on Friday, and given the fact that we have concerns in Russia as well, still ongoing, okay, and given the uncertainty, etc., regarding the Switzerland franc, and the ability for people to sit back and actually digest what the SNB move means, okay, that means there's a lack of faith in central banks and their ability to control the markets to a large degree. Okay, so that's basically the concern that we have. Okay, and those concerns alone will allow the markets to move lower, from my perspective, anyway. Okay, uncertainty is a killer, and that's something that we all try to attempt to avoid. Okay, and like I said, and plus even the fact that the QE is already there to a large extent, it won't be as much as everybody's expecting, etc., etc. So all those factors will certainly come into play as well. Right, so let's see where the markets are from a technical perspective. Okay, so you've had the inverted head and shoulders target, which has been complete at 2020. Okay, so where do we go from here now? Okay, that's the question. So let's start with a daily chart. Okay, daily chart is a bullish engulfing candle, so that's from the interim. That is classed as being bullish. From a technical perspective, that is bullish. Okay, so that's telling you that this market more than likely wants to test up this 2040 level on the upside, and the double bottom horizontal support has held. So we have trade based on what's held, and that's certainly held. So therefore we have to respect the support there. 60-minute chart. Okay, double bottom, triple bottom has held. We've broken out this wedge type pattern, and now we're obviously on the way or verge of a move out higher. So the next resistance level is 2040, 2050, etc, etc. Okay. Now 10-minute chart, like I said, it's a inverted head and shoulders formation. It's a 10-minute, sorry, that's a 15-minute chart. A 10-minute chart, inverted head and shoulders, and like I said, the target is the gap fill level, which is 2023, and then we'll see and assess exactly where the markets are heading from there. Okay, so the next indices that we observe is the Dow Transportation. Again, it's held a horizontal support. It's put a bullish engulfing candle in. 60-minute chart, again held intraday double bottom. Now looks like it wants to break out quite powerfully. Okay, and we also have the 200 MA that's been slammed as well. So given the fact that we've had this inverted head and shoulders formation, so you got left shoulder, head, 1 second, and right shoulder, off we go. Okay, so you're looking at 17,245, and then you're looking at 17,400. So you're looking at quite a substantial move here. Okay, on the upside with regards to that, and there certainly is some more room to go with regards to the Dow. Let's have a look at the 60-minute chart. Again, you know, we're looking at potential 200 MA on the upside. So again, that's certainly a possibility. And given the fact that it's lagging, so that's my only concern that I do have, is the US market's lagging. So we'll see exactly how that transpires come Monday. So now that we looked at Dow Transports, let's just quickly look at the variables that confirm the S&P 500 and the Dow to a large extent as well. Is the Russell. Okay, so Russell itself obviously has on the verge of closing this gap, has bounced, put a bullish engulfing candle in, so that's definitely a bullish sign. Okay, definitely a bullish sign. And as you can see here, we've had quite a thrust higher, quite a substantial thrust higher, and the market certainly does remain bullish for now. So one has to respect the bullish nature of the market. Okay, so now that we talked, let's look at Dow Transports. Now that we looked at the SPX. Bear with me. Okay, here we go. Dow Transportation Index. So let's start with a daily chart. Daily chart, obviously we've held that to double bottom or intraday bottom around the 8,600. And the 10-minute chart still looks quite bullish, although we have closed this gap here. So do expect some sort of interim resistance level initially, and we'll see exactly what the market does from there. The next one is a 60-minute chart. I can look at that for you. Okay, so that's gap fill resistance. Okay, so that's basically where we are with regards to that 60-minute chart. There you go, gap fill resistance, 60-minute chart. Okay, so again we've put in a double bottom scenario tab here. Whether or not this can go up to 10,900, again that will be debatable come next week. Okay, now let's have a look at the Nasdaq. The Nasdaq, I did highlight the inverted head and shoulder, which you've more or less already seen. Yes, we've held this horizontal support. Now we are looking for a potential outside bar and then a thrust higher. Okay, and let's have a look at semiconductors. Semiconductors still are into a bear flag size, that's a bearish sign. And Euro 350 has regained the last pivot high, so that certainly needs to be respected. And the volatility index is certainly meandering along too. So basically, what are we trying to achieve here by looking at all these multiple variables? What we're trying to achieve is whether to ascertain whether the market's in a risk-on or a risk-off environment. As you can see right now, it's in a risk-on environment, and the market obviously has hit its level where the market is supposed to look to reverse. So what I expect is a short-term pullback, and then obviously potentially carry on to make the previous highs, or potentially even break them as well. Okay, folks, that's my understanding of things, and the only thing that obviously can definitely a pullback initially, given the fact that the ECB or this report regarding Spiegel or Der Spiegel, and passing a report on to Miss Merkel, and she's talking down QE now. So expect a Euro pop and European markets to drop, and then I'll be able to assess exactly what happens thereafter. Okay, folks, so risk on, risk off, wax on, wax off. Goodbye.